What happened last week to push Treasury note and bond yields back up? Hello, members, super savers, and bond course fans. I hope you're healthy and well. Here are the 3 topics that we'll be covering in this week's Treasury update video. Did the economy really grow in June at the fastest pace in nearly 2 years? Where did bond yields end this past week? Plus, what's on the upcoming auction schedule? And what are the yield expectations for some of these auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Well, according to S&P Global reports that were released on Friday, yes, our economy may have been expanding quite nicely. The Manufacturing Purchasing Managers Index, PMI, it measures the activity level of purchasing managers in the manufacturing industry. PMI came in at 51.7 versus the forecasted 51.0. Any reading above 50 generally shows growth, and any reading below 50 generally shows decline. The PMI is considered to be one of the most reliable leading indicators when trying to figure out how the U.S. economy is doing. A leading indicator is one that can often help predict future performance before it happens. Chris Williamson, S&P Global Market Intelligence's chief economist, summed up the PMI report quite well in my mind. The early PMI data signal the fastest economic expansion in over 2 years in June. The upturn is broad-based as rising demand continues to filter through the economy. Do feel free to pause and read through the rest of this. I've also linked the document in the first pinned comment below for those of you who want to dive deeper into it. But the good news on the economic front seemed to go beyond the manufacturing sector that the PMI measures. The Services Purchasing Managers Index, Services PMI, it measures the activity level of industries that are less manufacturing focused, such as financial services, healthcare, and hospitality. The Services PMI came in at 55.1 versus the forecasted 53.4, signaling again growth above market expectations. This PMI report and the Services PMI report, both indicating a growing economy rather than a recession, were good news for bond yields. Let's move on now to the next section of our video to see how good. As we so often do at the end of a week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. The yield movements this week weren't that large, just a few single-digit basis points at most across the spectrum. But interestingly enough, they showed a pattern that could be read as our still inverted yield curve potentially taking a few more baby steps towards un-inverting. Very short-dated T-bills were down for the week in the 1-month, 2-month, and 3-month maturity range. The 4-month and 6-month maturities were exactly flat, becoming a pivot point of sorts for the yield curve. And at the longer end, everything above 1 year ended up for the week, as you can see here, presumably the effect of last week's upbeat economic data. Now, 1 week's worth of data isn't a full trend yet, and who knows how this will continue to develop. But as many of you know, I'm generally quite upbeat about the long-term outlook for the U.S. economy, and so I wouldn't be surprised if that development was more than a one-off. Of course, I don't have a crystal ball, but I'll definitely keep watching the space and we'll keep our community updated. Let's have a look now at how yields compare over a longer period of time. Relative to the beginning of 2024, bond yields are nearly all still up, as you can see from this table comparing Treasury yields from this past Friday versus January 2nd. This row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black and decreases in rates are shown in red. The 1-month and 2-month maturities are even further down than previous weeks, but otherwise, rates remain higher overall across all the other maturities. And again, we see that the yield curve has uninverted a bit since the beginning of the year. On January 2nd, the 1-month bill was yielding 1.47% more than a 30-year bond. Now, the inversion hasn't gone away, but as of last Friday, the 1-month bill was yielding only 1.03% more than the 30-year bond. Still a clear inversion, but the negative spread, the difference in yield, is down by about a third since the beginning of the year. If you have a comment or even a strong opinion about how Treasuries and the yield curve will develop, please post it below and share with everyone in the community. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Resource Center website here. All sources are linked below in the first pinned comment. As for the past week's auctions on longer-dated Treasury notes and bonds, the 20-year T-bond reopening auction fetched a high yield of 4.452%. This was the second lowest auction result since the beginning of this year and should not come as a major surprise given the decline in longer-dated bond yields over the past several weeks, as we discussed in last week's Treasury update video. And remember, the data that I showed you before, the par yield curves, as the Treasury calls it, are meant to measure the overall market, not the results of any one single auction. So the numbers for any auction can be slightly different from these par yield curves. But back to last week's auctions. The 5-year TIPS reopening auction came in with a high yield of 2.050%. Also lower than the 5-year TIPS auction in April, which came in at 2.242%. Having said that, in my mind, a real yield above 2% is still not too shabby, given that the current fixed rate on an I-bond is 1.3%. So, that was a recap of bond yields and auction results from last week. Now, let's take a look at the upcoming week's auctions. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 2-year T-note, the 5-year T-note, and the 7-year T-note will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupons are still to be determined. Also on the schedule is this 1-year, 10-month floating rate note reopening auction. At the time of this taping, on Fidelity's platform, here's what the coupon and the expected yield are for the 2-year T-note. And here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So, who's buying this week? And if you're interested in continuing the discussion on the upcoming week's auctions and anything fixed income related for that matter, then I invite you to join one of our upcoming live sessions. Our live Bond Masters course session will be on Monday, June 24th at 5:45 p.m. Eastern Time, 2:45 p.m. Pacific Time, with highlights of the 2-year, 5-year, and 7-year T-note auctions. And our next live YouTube member Q&A will be in July, with the exact date still to be determined depending on which auctions in July will be of most interest. The replays will be available afterwards as usual in the respective member and course areas. So, I hope you enjoyed this video and learned something new. And if you did and want a deep dive into how to invest in bonds and build a bond portfolio while yields are still attractive, then check out this video here on our 2 recently launched bond courses. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. All right, members, Super Savers, and bond course fans, good luck to everyone who's planning on buying at the upcoming week's auctions. And see you again very soon with more brand new wealth building content for your financial journey.